The US dollar held up well in the aftermath of the Fed decision. There was an initial round of profit taking that kicked in, but the dollar's setbacks were well supported and the buck has since been consolidating the latest round of gains. On net, there wasn't anything in the policy statement that would have US dollar bears wanting to be in attack mode, and if anything, the Fed's acknowledgement of inflation running back into its 2% target zone was only more encouraging of dollar demand. Given the implication, this would be putting additional pressure on the central bank to need to be raising rates. We would also note that just as the Fed had difficulty anticipating the return of inflation, it may have the same challenge on the other side if it expects inflation to move up at a more gradual rate. There's plenty of evidence that supports the claim that when inflation comes, it comes hard and fast, and this should be a risk the Fed will need to be taking more seriously in the days ahead. This is definitely a risk the equity market should not be taking lightly, and we believe this is appropriately reflected in Wednesday's decline. Higher rates makes for far less attractive stock market valuations, and we think it will be worth keeping a very close eye on that U.S. equities to 10-year Treasury yield comparative going forward. As far as other developments go, the market is back to watching all things U.S. trade and protectionism, with U.S.-China trade talks kicking off. Over in the UK, political drama is heating up as the Brexit overhang comes back into the spotlight, which means increased coverage of today's UK local elections. Looking at the calendar, key standouts come in the form of Eurozone inflation data, U.S. trade, and U.S. ISM non-manufacturing. Earlier today, Aussie got a bit of a boost on the back of a well-received trade report and March building approvals. We continue to see good value on the long side of the Aussie-Kiwi rate. That's all for now.